Welcome to the October edition of Around the Market. I'm Mark, and today we'll be looking at the ZOO indicator. And as always, we'll break down key indices and market trends. Let's start with the ZOO indicator, which is based on a survey of up to 300 experts from banks, insurance companies, and corporate financial departments. These experts share their 6 month expectation on the economy, inflation, interest rates, stock markets, and exchange rates. The ZOO indicator of economic sentiment is a leading signal for the German economy. In this chart, you can see the ZOO at the top and below it, Germany's main index, the DAX 40. We are not comparing an index with typical market data, but two different data sets. When the sentiment is negative, markets tend to move sideways or even downwards. Here you see some examples. In 2007 and 2021, the ZOO dropped ahead of the market. We might be seeing something similar now, or it could play out like 2014, a negative sentiment followed by a sideways market, then a rebound, and later a bigger 25% correction. Keep an eye on the charts in the coming months. Let's start with the European markets. The Netherlands. The index is trading above both moving averages. It's moving sideways between 89 and 93. Two trend lines, along with the moving averages, form a cluster around the 90, an important level to watch. Belgium, still one of the best performing European index, making higher highs and hitting resistance around 65. Key supports are at 62 and 60. France. The index couldn't break the first resistance at 37, and the 50 days moving average is still below the 200-day. Momentum is weak. Staying above 35 is crucial. A drop below 33 would be concerning. Germany. Like the BEL 20, DAX is performing well and remains above its 50 and 200-day moving averages. Short-term support is at 172, while staying above 164 is critical. Spain, another strong performer, continuing to rise until hitting major resistance. Short-term support is at 116, aligned with the 50-day moving average. Let's move to the S&P 500. In September, the index fell back but rebounded in our red rectangle zone, which was a short-term bullish sign. SPY is making higher highs than in mid-July. However, if we drop below 560, the correction might not be over, and we could see a deeper drop into the red rectangle, or even to 500 before bouncing back above 550 to remain bullish. Short-term supports are around 560 and the red rectangle. Looking at the cubes, the index is still below its July highs, but has reclaimed its short-term average. To stay bullish, it needs to hold above that average. Otherwise, we might see more sideways movement in a triangular pattern. I'll draw two important trend lines like this. For short-term bullishness, staying above 470 is key. I have made an Excel sheet with an overview of all components of the S&P 500 with the performance since the high of July and the sector. Out of 502 stocks, 328 stocks, or 65%, are trading above their July 16th close, so a significant number of stocks are participating in the upward move. Looking deeper into the sectors, only about 30% of stocks in the technology and automotive sectors are showing positive performance since July. These sectors are among the weakest. At the bottom of the list, you'll find many types of utility sectors, so keep an eye on those companies. And finally, let's have a look to the commodities. Crude oil. I was looking for a quick drop to 65, and we hit that target at September 10th. Short term, we need to move above the 50 days moving average and the support zone around 72.50. A drop back to 65 could signal further weakness, potentially down to $55. Gold. The uptrend continues, with the slope of the average increasing and momentum picking up. For miners, we need to see a breakout in silver for a broader move. Voila! Thanks for watching the monthly review. For more frequent updates, check out our weekly spotlights. Subscribe and hit that notification bell to stay on top of market trends. See you next time.